So the dividing of income, okay, once our business has, been in operation for a while, all right, we get to earn stuff. If their business is making money, okay, you and I as partners, all right, get a benefit. But the question is how much do we get? And again, as I said earlier, it all comes down to the partnership agreement. All right. And so whatever is specified in there is how we divide the income. Right? And so let's say that we're going to start an accounting firm. All right. So you guys are all going to be accountants. I am an accountant. All right. And we decide that we're going to start an accounting firm. Well, I'm the only one here that has a CPA. So I feel that I should get more money than you guys. You may agree to that. You may not agree to that. All right. Because you may come in and say, hey, yeah, you may have a CPA, but I'm bringing the bulk of the cash to the table. All right. I should get more income. Well, how's this all hammered out? Well, we agree. All right. And we definitely want to write it down. A partnership agreement really can just be a handshake. Right. But I wouldn't leave it there. All right. Because things might be rosy now, okay, but when we decide to separate, okay, things are probably not going to be as rosy, and so we definitely want to have this written down. All right. So common methods, all right, for dividing partnership, all right, based on services. Okay, so again, because I have a CPA, I should get more, all right, but you say, hey, but I'm doing all the work. I was like, so I'm going to give you an allowance and say, oh yeah, that's true. I'm only going to work a couple hours a week. All right. And you guys are going to do all the work. So, service of the partners. All right. And services and investments of the partnership and the criteria. And so we're going to actually talk more about this later when we talk about bonuses. Right? But right now, we're just going to run through some easy scenarios. Okay. So one method of dividing partnership income based on the services provided by each partner to the partnership. These services are often recognized by the partner's salary allowance. All right. And so in the real world, because I do have a CPA, I should be paid more. Okay. If you work more, you should be paid more. All right. And so we're going to go through and we're going to establish this allowance. Where do we find it? All right. We find it in the partnership agreement. That's where it's going to be written down. All right. And so we decide, all right, oh, and by the way, okay, if the partnership agreement does not say anything, all right, to the division of income, right, then it's shared equally, all right, and so I don't know if that's talked about here, all right, so if no, okay, if no partnership agreement, okay, then shared equally. Okay. Is there 2 L's in there? Equally? Whatever. All right. We're going to share, all right, the income equally. So if it's 2 of us, 50-50. If it's 3 of us, 1/3, 1/3, 1/3, right? And so on and so on and so on. Okay. So assume that the partnership agreement, all right, first of all, provides for monthly salary allowance, okay? And so Jennifer is going to get 5, Crystal is going to get 4, okay? Anything after that is divided equally, all right? So this would be written down, all right? Why is Jennifer getting more? Well, maybe she works more, okay? Maybe she's a CPA. Maybe she contributed more money, okay? Whatever, Jennifer and Crystal agreed, all right, that they're going to get $5,000 and $4,000 respectively. If there's more money after that, then we're going to divide it equally. So the division, all right, of $150,000 in net income, all right, would be reported on the bottom of the partnership income statement. Okay, and so they had revenues, expenses, all right, net income, all right, and so again through the closing process we had this information. But what we're going to do is we need to close these, all right, to the capital. Do you remember that? Okay. Close all revenues and expenses to capital. Well, now we have 2 capitals, and so we have to close these, all right, to each person. All right, and so of the 150, okay, if we took, she got 5,000, right? per month, and Crystal got 4,000. And so that's what they're doing is when they're multiplying it, all right, times the 12 months. Okay, that's how they came up with 160 and 48. And so of the 150, okay, you know, they've used up 108. That means they have 42 left. Okay, and so they divide that equally, all right, 50-50. Okay, and so they're going to divide that to 21. Right? So let me ask you, all right, how much money, okay, is Crystal getting, all right, this year? How much money is Crystal taking? Nobody's answering, all right. We don't know, all right, because if you remember, this is a partnership, which is very similar, all right, to a sole proprietor. When did the owner take money? Okay, when they had a draw. Okay, so this is not, the owner is not getting, all right, this $48,000 necessarily. Okay, she's being allowed a salary allowance of that amount. She doesn't need to take it if she doesn't need it. Okay, but I'll tell you what, she, Crystal, is going to pay tax, okay, on the $69,000. Because if you remember, okay, the business doesn't pay the tax, right? The owners do, right? And so these amounts is $81,000 for Jennifer and $69,000 for Crystal, are going to flow down to their personal tax returns. Not until we make a journal entry for a draw, okay, does either one of these guys get any money, right? Because a lot of times when a business is just starting, okay, they, you know, if you take money out, you can't grow your business, right? Okay. And so, you know, you let it ride, all right? It's referred to as plowing back profit. That you're, you know, you're putting any of the profits back into the business so that the business will grow. So as with other business forms, partnerships make 2 closing journal entries at the end of the accounting period. First of all, closing all revenues and expenses, right, to the capital balances. Okay? And then really this is where, you know, the dollars, okay, if they have a draw, okay, is the amount of cash that they're taking out of the business. Okay? And so the journal entry, right, for the closing, right, we close revenues, right? We close revenues because it's normal balance is credit. We debit those. We close all the expenses. And yes, in the real world, you can't just put expenses. You have to list each of those expenses individually. All right. They didn't really give them to us here, but you would have to theoretically have salaries expense, wages expense, you know, rent expense, and all those things. All right. And then we come up, right, based on the table from the, you know, last screen, right, the increase into their capital. I'm going to say this the last time. The only difference between a partnership and a sole proprietor, I'm sorry, a partnership and an LLC, okay, is the account name that we use. Okay. Over here we used capital, right? For the LLC, we use members' equity. And so, you know, they say here in this scenario that they did take out their salaries, okay? And so, you know, we would make those journal entries for the amount that they did take out, right? But just because they were given that allowance does not mean that they have to take out the 60,000 and the 48. Dividing income, service of partners and investments. A partnership agreement may divide income, all right? Like I said, you know, that's how we do it, all right? Based on some interest on capital of each partner, okay? You know, but it would have to be documented in this partnership agreement. Right? One method of dividing partnership income, all right, there's the partner's salaries, okay? But if you put in, all right, something into a business, shouldn't you expect a return on that? And that's what we're trying to address here, all right? What we're trying to look at that's different, we just covered the partner's allowances, okay? Now what we're going to be talking about is the interest on capital investments. Again, this is not necessarily for every business. However, if you are going to have it, you need to disclose it in your partnership agreement. So in this case, they assume that they're going to get, you know, not only their monthly allowances, but they're going to get interest of 12% on their beginning capital balances. Right? And so again, Jennifer here, she contributed more money, right, to the business, or assets. It could have been assets that she contributed. Maybe that's why she's getting more allowance. Who knows? Okay, but each one of these two capital balances should get some interest. All right. So what we're going to do in the next thing, we're going to just multiply this times 12%. Okay, to find out their interest. So looking at the table, all right, we currently still only have, you know, 150, 150. Okay, how are we going to divide that? Right? Well, we first do the salaries allowance. And if you remember, we had excess. Now what we're going to do is we're going to give, right? We're not actually paying them anything like that, but we're giving them credit, right, for their interest allowance. So that's second. Okay. And the calculations are down here, right? So they took the beginning balance times 12%. We got the 19,200, right? And the 14,400. We still have a little bit left, right? So of the 150, we used 141.6, okay? And so we're left with 8,400 that we're going to divide equally, all right, for 50. Again, we want to make sure that this is all recorded in their partnership agreement. Journalizing, okay? You know, so we're just closing it, and we're now adjusting for that interest between Jennifer and Crystal. In some cases, all right, net income might be less than the total allowances. In this case, the remaining net income is going to be a negative amount, all right? How do we do it? Well, we're going to do it based on the partnership agreement, aren't we? Because they can be different. It can actually be different. You could say that we're going to split income 50-50, but we're going to split losses 60-40. All right. It again would all be determinants, all right, on the partnership agreement. Right? And so take note, okay, that these first things, all right, 1 and 2, okay, are not any different, but you know, we've only made 100,000, okay. And so, you know, we're attributing 141.6, all right, when we've really only made 100, okay? And so what we're going to do is this, in essence, all right, is the amount that is over, and we're going to split it 50. And so the journal entry, all right, basically reflects the new capital balances. So I'm going to break it off here again and start it right back up.